Hey everyone, Kevin here. This video is going to be quite important for trading in the stock market this week and for longer term investors in terms of what we could expect to happen to the real estate market, the longer term stock market. Should we be in defensives? Should we be in cash? Should we be in tech stocks? Are we gonna get a St. Paddy's Day rally? Well, that's what we're gonna talk about in this video. It is worth noting that St. Paddy's Day is the day after the FOMC meeting ends. The meeting begins on the 15th of March. That's this Tuesday. It ends on the 16th, which is this Wednesday. And this Wednesday at 11 a.m. California time, we will get an FOMC statement along with a summary of economic projections from the Federal Reserve, followed by about a 45-minute press conference wherein Jerome Powell will be answering questions from the press. Generally, I find the questions from the press are actually a lot better than the questions that we see in Congress when Jerome Powell goes to testify before Congress. The last time that we heard from Jerome Powell was about 2 weeks ago when he did testify before Congress, and the big things that we learned from him 2 weeks ago were that he thought this war was a game changer and that obviously there would be inflation that comes from the oil and energy shock, but that he expected the adjustments from the oil shock to be sort of a one-time impact to inflation. That is something that is not transitory, that isn't even necessarily remotely recurring, that is more sort of a one-time, all right, here it is, and then it's gone. And so what we're going to want to do is break down what we expect for the summary of economic projections and exactly what to look for in terms of how Jerome Powell's tone changes, because it's really going to set the pace for stocks and crypto. Keep in mind, if you want all of the knowledge that I have in investing and you want to join me in the daily live streams that we do every day the market opens up, where you can ask me questions directly just to get a different perspective, make sure to check out the programs on building your wealth down below. There is a coupon code that expires in about 2 weeks. It's linked down below. You could use that. And the price does go up over time. All right, folks, let's get into the SEP. So this is the last time that we got an SEP. Now, this seems crazy, but the last time that we actually got this was December 15th of 2021. They only come out every about 2 to 3 Federal Reserve meetings. And in January, at the FOMC meeting in January, during the press conference, Jerome Powell said that if he had to go back to December and do his SEP again, do his sort of projection, that he would expect that inflation would actually be a lot higher, that he would go back and revise his expectations up for the end of the year. And so what this is basically people like Jerome Powell and the other folks on the Federal Reserve Board, they get to write down what they project inflation is going to be by the end of the year, the unemployment rate's going to be by the end of the year, and what interest rates will be by the end of the year. And so the way you can see this here is we're going to go ahead and remove all these annotations from all this junk that we've previously written down. And the way you really want to read this is you want to see 2 things. First, you want to see the median, which is really your middle number. It's better than the average for a purpose like this because a really low or really high number could really skew the average a lot. So we're going to go with the median numbers here. And really, we're in 2022. So what we're looking for is what is the Federal Reserve's median estimate for inflation at the end of the year, the unemployment rate at the end of the year, and GDP at the end of the year. These are some huge numbers. And then, of course, the federal funds rate. Then what we're also going to be able to see is the difference between their prior projections. See, previously their projection was September and then to December, where we saw these larger increases, right? So I'm going to write down my expectations here, and then we're going to talk a little bit about ranges and some of the other things that we have to pay attention to. So the September projection for the Fed funds rate said that at the end of 2022, we would have 0.3% as a Fed funds rate, which is obviously wildly unexpected. At this point, the market's pricing in as high as about a 2% rate. One of the reasons you might see this pull forward is because the unemployment rate has fallen substantially faster than we previously expected it to fall. You can see here that we expected the unemployment rate at the end of 2021 to be about 4.3%. And what's remarkable now is if we just type into Google the unemployment rate now and we get the BLS employment statistic, we're already at 3.8, and we're at the March reading for employment. I'm sorry, the February reading for employment, since we always look 1 month back, and we're already at 3.8. So we really expect, the pen stopped working. We really expect by the end of the year, 3.5 should be a no-brainer. And when we move up the expectations of how quickly the unemployment rate goes down, then another thing that we can do is we could start moving up how quickly we expect to move rates up. So it wouldn't surprise me to see the Federal Reserve basically just take the items from this column and say, okay, instead of expecting these numbers by the end of 2023, we're gonna move them up because unemployment's going down so much faster. We're just gonna move the items from this column over since everything's happening about a year earlier. So I would not be surprised to see the Fed funds rate come in at about 1.6 for the median. Now, I really like the range, the central tendency range over here. This just shows you the low and high. Sorry, not the central tendency. We're gonna go over here. This is the range that we want. Here's the range for 2022. And so the previous range was about 0.4 to 1.1. I would expect to see this be somewhere between 1.4 to potentially as high as 2.3. And that's gonna give us sort of that midpoint of about maybe 1.6 to 1.8, depending, because median's not gonna be average, right? So there could be more people on the lower side, but I do think there'll be a few hawks that'll really show this higher, like 2.3. And we'll talk a little bit about what happens if we get some worst case scenarios here as well. Now, for inflation, they like to use PCE, which generally comes in a little bit lower than CPI, which you'd think CPI is already like manipulated to the downside. Yeah, this comes in even lower, but that's okay. Obviously, PCE, we're just gonna focus here on the headline number here of PCE. It's not gonna be 2.6. Everybody knows it's not gonna be 2.6. I personally would expect, and we're not even gonna move this over 1 year because we're gonna be way higher. We've got two forms of inflation now. We've got the old transitory inflation, which has become a lot more persistent. Those are your supply chain issues. And then you have the new transitory inflation, which is sort of your oil price shock and your food commodity price shock. Nickel, palladium, wheat, oil, natural gas, all of these things. These are going to have, as Jerome Powell put it, a quote unquote one-time price shock. Unfortunately, one-time price shocks can take about a year to actually disappear. So we're going to be paying a lot of attention to the month-over-month data when it comes to inflation, because the one-time price shocks will just keep showing up for a year until, and that's why you're always going to look for those month-over-month inflection points to the downside on inflation. But anyway, I would expect this to come in substantially higher. It's probably going to be closer to 5%, but I wouldn't be surprised if the Fed comes in here and says something like 4.5%. And remember to always mute your phone before you end up filming a video, because that gets quite annoying. But anyway, then the unemployment rate, wouldn't be surprised to actually see them leave this at about 3.5%, because you can see here their longer run goal is 3.5%. And so this is sort of in their minds their definition of maximum employment. And this is really just a way of them saying we're already good. We've already essentially achieved our goal, sitting at 3.8%. We're probably going to go down to 3.5 way before the end of 2022. This will say 3.5 across the board. Unemployment's checked. Remember, their dual mandate. Mandate number one is maximum employment. That's already been achieved. Mandate number two is stable prices. That has not been achieved. And so that's why we're going to be working on inflation here. The issue is, to deal with inflation, you've got to raise rates, and everybody's worried about the potential for a rug pull. That is, markets getting Paul Volckered, and all of a sudden us seeing a substantial increase in interest rates much faster than expected, which could lead to shocks in the mortgage market and shocks in the stock market, and lead to substantially more valuation compression. There's some real potential downside risks to markets and upside risks to inflation. Okay, good. So these are what we're going to be looking for on the SEP. My belief is, if we end up seeing something substantially higher than these numbers that I wrote here on the SEP, the market's going to be very sad. Now, right now, the market is pricing in about a 95% chance of a 25 basis point hike. So it pretty much means we're almost guaranteed to get a 25 basis point hike. The Fed could shock the market. If they do something other than 25 basis points, it would be really unexpected and markets would react. If they kept things at zero, I think markets would rally, although there'd also be a weird head scratching here that the Fed's just kicking the can down the road. And if they went into the 50 basis point, that would be a problem. The markets would not be very happy about that because markets aren't expecting that. But the Fed doesn't like to do things that shock the market, though the Fed will do things that lead the market to go down. They just don't want to do that in a way that would shock the market. That's an important distinction there. It's okay for the Fed if prices go down because that actually de-risks markets. It's bad when they do so as a rug pull. And that's what the market's trying to expect. So for example, if we go over to May, we're only expecting a quarter basis point hike. We go to, this is for the, that's March 16th. Same thing for May, expecting a quarter basis point hike. Same thing over here, expecting a quarter basis point hike. And basically the market's pricing in a quarter point all the way until July, where there's a little bit of a greater chance that the Fed actually comes in and it potentially says, hey, you know what? We're going to do nothing. And we're going to pause on rate hikes is actually getting priced in right here. Do zero. But of course, the majority here is suggesting that quarter basis point hike. And then you go a little further and you see another quarter basis point hike. So really, the market is not pricing in any kind of 50 basis point hike. So if we go to the end of the year, you can see the market thinks we're going to end the year with a 42% chance, somewhere around 1.5 to 1.75. Right now, we're technically at 0 to 0.25. So generally, you always read the first number is the trick for this. Well, if the market says 1.5 is the most likely scenario, maybe slightly edging on the higher side, you know, it's kind of funny. It kind of aligns with exactly what I wrote here. And you might not believe me, but I actually wrote 1.6 before I looked at the rate futures. So I'm kind of glad that we're in alignment. I like to see that. See, I like to write down my assumptions first and what I believe based on all of my other research is going to be likely. And then I can compare to other data. So that way, if I'm completely off, I can look and go, okay, why? But this is a perfect alignment here. And I kind of expect that based on what I see in the market and the research that I do. So anyway, 1.6%, which remember, if you want to talk to me about the research that I do, join those live streams. Every day the market opens up. We do a solid 45-minute Q&A live stream. We talk real estate, stocks, YouTube channel growth. We talk about everything. Anything you want to talk about, we talk about. It's great. And use that coupon code down below. You can also bundle up for the other programs. Okay, so now 1.6 on the Fed funds. So this is what the market's expecting. This is what I'm expecting. Everybody's expecting maybe 1.6 towards the end of the year. So where does this become a problem? Well, I'll show you where this becomes a problem. This becomes a problem if the Federal Reserve ends up suggesting something other than this. If we end up getting a median read of 2 or even worse, like 2.25, I would expect the market is going to react very negatively. The market is not, in my opinion, going to react to, oh, they did a 25 basis point hike. We already know they're going to do that. That's old news. This is what's going to matter because this is going to forecast how many more hikes we have ahead. Now, how many meetings do we actually have left this year? Well, you've got the March meeting, but that's going to be done. That's going to be your first 25 basis points. Then you got May, June, July, September, November, and December. So you got 6 meetings left. If they did a 25 basis point hike at every single one of those meetings, in addition to this first 0.25, that would put us around 1.75. This is where we would end up the year, 1.75 to a range of 2, right? This is where we'd end up. This would be kind of in line as well. So worst case scenario, if this ends up being a 1.7, I don't think it's going to be a big deal. But if it's anything like a 2 on the low side, that is the first number of the range, 2% to 2.25, that's going to scare folks. And I think folks are going to look at the median here because remember, this is the vote. This is not down to one person, it's a vote. The range is going to matter. You know, if we saw something like 2% to 3% in the range for 2022, that's going to freak markets out. Markets aren't going to like that. Though, sometimes the Federal Reserve likes to plant seeds here that they plan on being more aggressive as a way to kind of like start bursting the bubble to the market. So this is a way that they can communicate their potential expectations and then try to get the market to align. So you could see a very quick market movement if we did get it in something like this. I would say this right here would be concerning. This would be a sign that the Federal Reserve is losing faith that they can actually control inflation. Right now, they're playing a game of patience where they do believe that if they're patient enough, they're going to end up seeing the first supply chain transitory inflation fall, and then this energy and food shock inflation eventually also fall, especially once the crisis in Ukraine ends, which, knock on wood, is hopefully very soon. Now, this inflation reading number right here, and again, we're assuming this is going to be 3.5%. If this goes up, then it starts making you wonder, like, hey, is the Fed expecting recessionary signals? Which obviously they could also signal here. Now, last time they raised GDP from 3.8% to 4% as a forecast, it would not shock me at all for the Federal Reserve, because of the war and the crisis and everything, to end up saying, hey, we expect, let's say, 3% growth by the end of the year. This would not shock me at all. If this ends up coming in with something like a 1%, which I don't think, but if they end up putting 1% here for growth and then they blame war or whatever, this is going to be very scary. And it's going to be very scary because 1% is so dang close to recession, because you get negative for 2 quarters in a row, boom, you're in a recession. So I don't think this is going to go up. I don't think it's going to plummet. I think maybe 3% is going to be a big adjustment down, right? From their previous estimate here of 3.8 or 4%. It's going to be a big jump down. Maybe it ends up coming in at like 3.5. I almost certainly expect it to come in less. But if it comes in at like a 1 or 2%, markets are absolutely going to lose it. So we're just going to say the blue line here, very, very sad. If this comes in higher, it's a good thing. But 1 to 2% would be very, very bad over here. 2 to 2.25% would be very, very bad. And the inflation reading, I don't think will matter so terribly much, because there's just really a shot in the dark. Again, I expect them to come in at 4.5. If they expect inflation to come in at like 7%, I really don't think they will. This is very, very unlikely. That's going to give markets some cause for concern, because it's going to mean the Fed themselves is kind of like, yeah, no, we're screwed. And then the other numbers would probably align more closely to a 1 to 2% anyway, or 2 to 2.5 or 2.25% rate for the FOMC. So these are going to be things that you want to watch for. But there are going to be more things that you want to watch for as well. So just as a quick summary, you're going to want to watch for that GDP prediction. How low is it going to go? Anything with a 1 or 2 in the front, bad. We're going to want to watch for that, not so much the inflation number, the unemployment we expect to stay at 3.5. We're going to watch that FOMC Fed funds rate. Is it going to come in at 1.6? Anything with a 2 in the front, it's going to be bad. That's not going to be juicy, okay? So very, very important. This piece of paper here is going to be critically important to how the market responds, much more so than the stupid headline that you're going to see on, not the bag on CNBC, but it's going to be the headline on CNBC. Fed for the first time in 4 years or whatever, hikes rates 25 basis points. Oh my gosh, lift off. Everybody expects this already. Old news. Next. Like, there's no news there. No news at all. Okay. The next thing that we need to pay attention to, well, there are 3 little things that we want to pay attention to. All right, and before I hit these things, if you don't mind, if you haven't checked out the programs on Building Your Wealth link down below yet, ask yourself why. And if you wouldn't mind, leave me a comment down below. Is there something missing that you'd like to see in the programs? Is it, would you prefer like a one-day sale, or what's stopping you from joining the amazing community that we have for the programs on Building Your Wealth? And I'm always thinking about adding content too. So you just letting me even know in the comments, oh, if you had something on this, I'd be more interested. Hey, we can make it happen. So I'm curious. All right. So this is what else you want to listen to. So number 1 is the SEP, the Summary of Economic Projections. Number 2, you want to look for the danger of what we call the license to hike. So the Federal Reserve, in Jerome Powell's discussion, is probably going to be testing in the way he answers questions and then watching to see how the market responds. Basically, hey, do we have permission to go for essentially like the rug pull, right? The 50 basis point hike. This is going to be very subjective in terms of how we analyze the license to hike. If Jerome Powell suggests, hey, if by July the data doesn't improve, then we might have to be more aggressive with our tools, that is going to be a very clear license to hike. And the market's not going to like that. That might be reflected in the SEP. It might not be. See, because the SEP will be their expectations for the end of the year. But then Jerome Powell's also going to give us his forecast. He's going to say, hey, if we're wrong with our expectation, then we'll go for a larger hike. And then the question is, well, how high? Would you ever raise the rates 1%? Would you ever raise them 2% just to Paul Volcker us and get rid of inflation? And depending on what he says there, will be very large recessionary signals, right? So then we've got the level of dovishness to measure. So number 1, SEP, number 2, the license to hike, and number 3, the level of dovishness. So the ECB shocked us a little bit. They tapered their stimulus much faster than expected despite war, and despite the fact that we expect a war to affect Europe substantially more than it'll affect the United States. And so when the ECB went hawkish on Friday and Thursday, we saw markets turn substantially more red. That was a big deal. That was a big problem. So the level of dovishness because of war is going to be something to pay attention to from J. Powell. How dovish is he because of war? How much does war delay his interest in fighting inflation. He might suggest, hey, well, we're going to delay fighting inflation until essentially the geopolitical concerns are over, because we believe that the geopolitical concerns will actually help reduce consumer demand globally. And thanks to the velocity of money, we'll see demand go down here in the United States, which won't be good for earnings. He won't say the part about earnings. But when demand goes down, inflation goes down, right? Then we're going to look at his definition of sort of the two types of inflation. Does he actually believe that there are two types of inflation? That is the transitory supply chain one, and then the one-time energy shock one. The one-time energy shock one is something that we really want to pay attention to. Is Jerome Powell going to say, hey, this could lead to lasting inflation that just becomes more perpetual? Or is this, as he said before, a one-time hit and then it's over? I don't really expect a lot of talk about CBDCs. There are a lot of like conspiracy theorists and stuff that are like, oh, central bank digital currencies are just designed to tell you where you can shop and can't shop. And whatever. I'm not terribly interested in that. I think if you don't want to use CBDC, don't use it. And it's nowhere even close to here. Central bank digital currencies are, I think, something we won't see until 2025. Certainly not from the Federal Reserve, maybe from China, but it'll probably be garbage. Oh gosh, this is why I can't visit China, because I say things like that. I'm sorry. I'm sorry, China, if you're watching, I didn't mean it. Okay, so anyway, look, it's going to be a big day Wednesday. I'll live stream the meeting because it is such a big day. But otherwise, if you want to talk to me, you got questions, join those live streams, folks. Leave me some comments down below. Thank you so much for watching, and folks, we'll see you in the next one. Bye.